Infrastructure assets are physical assets that are critical to the economic and social functioning of society. Infrastructure spans multiple sectors, including transportation, energy, utilities, digital, and social infrastructure. The key characteristics that we look for in attractive infrastructure assets across all sectors are the same. Long-life assets that provide essential services with inelastic demand. They hold a monopolistic position or have high barriers to entry, with inflation linkages and predictable cash flows. When you look at the portfolios of institutional investors, like the large Canadian pension plans, there's an average allocation to infrastructure of around 9%. Some, like OMERS, target as high as 25% long-term. There are a number of reasons driving this. First, infrastructure has a low correlation to other asset classes. From 2008 to 2020, it had a correlation coefficient of negative 0.1 to global bonds and equities. Second, infrastructure generally has low volatility relative to equities given its monopolistic nature and provision of essential services. Third, infrastructure can provide inflation protection as it has inflation linkages through contracts, regulatory frameworks, or monopolistic positions. Fourth, infrastructure can provide ongoing yield supported by relatively predictable cash flows. In addition to these attractive characteristics, infrastructure has delivered historical annualized returns of 11% over the last 10 years. NIRR aims to replicate the approach taken by institutional investors, investing in global funds and co-investments. We select managers with proven investment track records that we can be long-term partners to. We invest in OECD countries in North America, Europe, and Asia Pacific with relatively stable regulatory environments. And by diversifying across managers, geographies, and sectors, we can access a wide set of attractive opportunities with diversified revenue streams. There is a huge need for infrastructure investment across all sectors. The G20's Global Infrastructure Outlook estimates that there's a $15 trillion funding gap globally. We are incredibly excited that our investments can address issues like global warming by investing in renewable energy, or access to clean drinking water by investing in water utilities.
We are investing in infrastructure that supports supply chain resiliency, as COVID-19 showed the weaknesses in existing supply chains globally. Where we have seen new opportunities emerge are in the digital and energy transition space. The digital infrastructure space has been driven by the ever-increasing demand for data. The energy transition space has been driven by the push for net zero carbon emissions from public focus and private sector commitments.
We have an open-end fund structure where units in our fund can be bought and sold on a monthly basis with a 6-month redemption notice with no explicit fund term. Our open-end fund structure is somewhat unique, as until recently, most infrastructure funds followed the traditional private equity closed-end fund structure. Because our open-end fund structure has no set exit date, it allows us to apply a long-term approach in our infrastructure investment decisions, which aligns very well with the long-term nature of the asset class.
If we think about directly investing in infrastructure assets, the typical individual equity investment size is in the hundreds of millions or even billions of dollars. Even if you can individually afford that minimum threshold, that impacts your ability to diversify by manager, vintage, and assets. Our infrastructure fund provides our clients with access to a diversified set of managers and assets by pooling capital with no investment minimums. Using our combined scale, we can negotiate better fees and access co-investments alongside our fund manager partners.